Sanjeev Bijli, ED of PVR Inox, and Saurabh Pant, VP Finance and Investor Relations at PVR Inox, with us on the show. Gentlemen, good having you. Thank you so much for taking the time out and being with us. For a lot of people and a lot of businesses which are entertainment, travel focused, what's happened over the weekend is a relief as well. But Mr. Bijli, for you, maybe not so much of a concern with regards to geopolitics, but how would you summarize what's happened in the quarter and the year? And is it possible to hypothesize if FY26 can be materially different than FY25?
Yes, of course. I think we believe so very strongly because we know exactly why the last quarter in FY25, or even for that matter, FY25, the entire year, was muted and didn't go as expected because of underperformance of a lot of Bollywood films. And that came because our major superstars like Shah Rukh Khan and Salman Khan and Aamir Khan, there weren't any films from them. Plus, there was a huge drop of Hollywood releases. Our cinemas are basically spread across the country, and they are situated in demographics where a demand for English movies is very high. The Metro, South India, Bangalore, Delhi, Mumbai. And because of the Hollywood strike that happened post-COVID, a large number of Hollywood movies, including Mission Impossible 8, which is now releasing on the 17th, got shifted. So since our chain is dependent a lot on Hollywood films, plus there were fewer Hindi movies, that is the reason why there were muted admissions. But this year, everything seems to be back on track, be it Hollywood, be it Hindi film, big films, and also regional films, which continue to contribute to our box office.
And Mr. Pant, let me come to you. Harsh also joining in. What is therefore the reasonable number in terms of growth that you would expect to clock for FY26?
Yeah, hi Harsh. I think in terms of why we don't give any forward-looking guidance on admissions or growth, our internal estimates are that this year should be materially better than FY25, and directionally it could be better than FY24 as well. So in FY24, we had done about 151 million admissions. In FY25, we did about 137 million admissions. Our internal estimates are that it should be directionally better than FY24. So obviously significantly better than FY25.
And Saurabh, I'll stick with you. What is the outlook with regard to debt? You've reduced debt to a certain extent, but net debt stands at roughly 950 crore, if I'm not wrong.
That's correct.
How quickly does it go to debt-free?
Yeah, so I think at the start of the year, the management had decided 4 key priorities, out of which one was to deleverage the balance sheet and make it stronger. I think we have managed to, even in a year which had certain headwinds with regards to content, we have managed to reduce debt from where we were in FY24. If you look at a 2-year trajectory, we have managed to reduce our debt post-merger by almost 482 crores. And as you correctly mentioned, we currently stand at about 950 odd crores. So I think going forward, while again, we do not want to give any guidance, but the endeavor is to deleverage the balance sheet as quickly as possible. And if the content lineup is as strong as it appears to be on paper, I think that should happen pretty quickly.
Okay. Mr. Bijli, just one question around whether the nature of the business or the model changes because the nature of the viewer and the options available are much more, let's say, than maybe 10, 15 years ago. So when I look at the outlook, there's a capital light model, 101 screens signed under that model, expected to come over the next 12 to 24 months. Is this a company like yours, which is a leader in this space, trying to do things differently so they're in order to manage balance sheet and cost pressures in what has become a difficult to predict business?
No, absolutely, you're right. I mean, I think, while the endeavor is to go back to the admission levels pre-COVID, we are also very conscious and have decided strategically that we must look at our cost structure, be it fixed costs or variable costs. And we're basically attacking both of them and trying to reduce them as much as possible. And as far as the Capex is concerned also, towards building out new screens, we still believe we need to build out new screens. We are not stopping growth because there are many markets in the country, especially tier 2, tier 3 cities where we are getting incredible locations and incredible opportunities to open a multiplex. But we want to reduce our Capex intensity by following these two models. One is the FOCO model, where, of course, the developer believes in the brand and our management capabilities and is therefore ready to invest 100% investment into the multiplex. And the other is an asset-light model, where we are sharing the cost of the fit-outs. We've received overwhelming response on both these models from our developer partners. And it only goes to prove that they believe, the multiplex viewing experience, cinema, is still a very integral and important part of their developments. And B, they also believe in our brand and our operating capabilities to be able to put their money and let us operate it in the most efficient manner. So we're trying to reduce our Capex intensity, but at the same time, very committed to increasing the number of screens, and in order to safeguard ourselves from this volatility, which is coming from either consumer change in behavior or the way movies are performing, we are very, very strictly looking at all other costs and reducing them.
Right. Mr. Bijli, what's the outlook with regard to new screen openings for FY26? One is, how many are you planning to close from a perspective of eliminating a bit of inefficiency? What's the chop and change going to look like?
I think this year we're looking at adding 82 new screens.
Okay.
I mean, the beginning of this year in April, we already opened 20 screens, one in Noida, one in Jabalpur and Raipur, which also shows our commitment to open screens in smaller centers as well, where the demand is still there, and another one in Gurgaon. In addition to that, we're opening 82 more screens across the country, and some of them are in still our strategy, and our growth strategy is to look at South Indian cities where the demand remains robust for our business. Also look at smaller cities where they haven't really seen much of a retail revolution and a multiplex presence as yet. As far as number of screens that we need to close, we're still working on that. Of course, we are looking at a list of cinemas which are just not delivering anymore, either because of competition or the developments have become dilapidated and old, and we're working on that number, and we'll decide on that very soon.
Right. And Mr. Bijli, what's the logic? So you are closing down certain screens which are underperforming. How do you judge which ones to close? Just give us that perspective.
I mean, first and foremost, it's a financial performance. If those properties haven't been performing well consistently for the last 2-3 years and have been delivering a negative EBITDA, and we feel there isn't much that we can do to revive that, then that's one criteria. Second, of course, you must understand that some of these properties are very old now. They've been housed in malls or shopping centers which opened about 20 years ago. And there's always a product life cycle as far as these developments are concerned. They become dilapidated, the infrastructure becomes very poor. Some other tenants, which are anchor tenants, leave, and they all go to newer malls. There are newer malls and newer developments coming across the country every year. And other tenants also tend to find those more attractive because they are new and fresh. And therefore, the chances of success there for us or a retailer are even higher.
And out of the 82 screens that are expected to open, Saurabh, let me come to you. How many of those under the capital light model, or all of those will be capital light? How does this work?
Sure. So, Harsh, we'll open approximately 100 to 110 screens this year in all. We have already opened 20 screens in the past couple of weeks, and another 80 odd to go. Just to put this in context, about more than 50% of these screens will be under the capital light model. It will be either a management screen or an asset light screen.
And Mr. Bijli, What's the pressure like from competition? You have some of your competitors reducing prices in the food and beverage space as well. Are you seeing a bit of a shift with regard to your viewers opting for competition over you due to that? Are those trends at all playing out, or are they worrying you?
I haven't seen any major price reductions across the sector. Honestly speaking, I haven't seen anyone else dropping prices. I've checked the prices for other cinema chains as well, at least the bigger ones, that are out there and operating and doing a great job in the cities. I really haven't seen much of a price drop at all. But at the same time, we're very sort of conscious of what the consumer wants. And we have done many promotions and many strategies to actually counter any of this. We have on the pricing side also, we have 99 rupees on Tuesdays. We have a Cinema Lovers Day, which comes out every quarter. Even on F&B, we have special offers which are coming out every couple of days. So if you actually look at our website and our app, there are a lot and many more promotions that are out there, which we feel should not hurt the customer. And therefore, we are committed to making the whole experience as palatable as possible.
And Saurabh, what's the sense like with regard to Karnataka capping prices at 200? Is there a risk that other states would follow, and what would the impact of that be with regard to your numbers?
So when this announcement was made a month or so back, we made a representation to the state government and outlined the heavy investment that we have made in the state over the years because the prices were deregulated. Since then, the budget has been announced, but there has been no government order on pricing. So it is status quo. There has been no change. The pricing is still deregulated. And I think other state governments are also following suit in keeping the prices deregulated. There are only a couple of states left in India now where the prices are regulated. The likes of Tamil Nadu, Andhra Pradesh, and largely these two states are now having regulated pricing. Otherwise, it's deregulated all across.
Point taken. Okay. Thank you so much, Mr. Bijli, as well as Saurabh, for joining us. Great having perspective on consumer trends as well as, of course, the numbers for PVR Inox and breaking that down.